Something happened in March 2026 that almost nobody is talking about. There was an active war in the Middle East. Oil spiked to $119 a barrel. The whole world was nervous. And you know what gold did? It fell 10% in a single month during a war. Now, if you've been told your whole investing life that gold is the ultimate safe haven, the thing you hold when the world goes sideways, that should stop you cold. And here's the other half of that story. Bitcoin, widely seen as one of the most volatile assets on the planet, remained remarkably resilient, flat, on the breaking news of a global oil crisis. So either everything we thought we knew about these two assets is wrong, or something much bigger is happening underneath the surface. Something in a market that most investors never watch closely enough. The bond market. Welcome to Bitcoin Capital Gold. This is part one of a special three-part series we are bringing to our Bitcoin and gold viewers. The bond market is the largest financial market in the world, and understanding what bonds are doing right now is the single most important thing any gold or Bitcoin investor can do in 2026. Part 1 sets the stage: what bonds are, why they move gold and Bitcoin, and what the current environment is telling us. Part 2 goes deeper into why gold and Bitcoin don't react the same way to bond moves, and why that difference matters enormously to how you build a portfolio. Part 3 brings it all together. When bonds change direction, how should you position between gold and Bitcoin? But we start here, with the foundation. Let's go. All right, let's start with the basics. And we promise we're going to keep this grounded in plain language, because the bond market gets unnecessarily complicated in most explanations. Think of a bond like this. The U.S. government needs money. It needs to pay its bills, fund its programs, service its debt. So it goes to investors, big banks, pension funds, foreign governments, ordinary people. And it says, lend us money. We'll pay you back in 10 years, and every year we'll pay you interest. That interest payment is called the yield, and that yield is where everything gets interesting. Right now, the United States has roughly $39 trillion in debt. That is more than 130% of everything the U.S. economy produces in an entire year. And every year, the government has to go back to the market and say, please keep lending us money. The question the bond market asks back is, how much interest are you going to pay us to take that risk? When investors feel confident, when they trust the dollar, when inflation is low, when the economy is stable, they'll accept a lower yield. They'll lend to the U.S. government cheaply. But when investors start to worry, when inflation is rising, when the government is spending more than it earns, when trust in the dollar starts to erode, they demand a higher yield. They want more compensation for the risk of holding U.S. debt. And here's the critical thing to understand before we go any further. Bond prices and bond yields move in opposite directions. When yields go up, bond prices go down. When yields go down, bond prices go up. That sounds backwards. Here's the one-sentence way to remember it. If a new bond is paying a higher interest rate, your old bond paying the lower rate is worth less, so it falls in price. Now, why does any of this matter to someone who holds gold and Bitcoin? Because the bond market is the single largest financial market in the world. It is bigger than the stock market. It is where the biggest money on the planet, central banks, sovereign wealth funds, pension funds managing trillions, decides how to allocate capital. And when that market moves, everything else moves in response, including gold, including Bitcoin. Now, we want to introduce one number that, once you understand it, will change how you read financial news forever. It's called the real interest rate. Here's how it works. The bond market pays you a nominal yield, let's say 4.5% on a 10-year treasury. That sounds okay. But what if inflation is running at 3%? Then your real return, after inflation eats into your purchasing power, is only 1.5%. Real rate equals nominal yield minus inflation. And this real rate is the most important variable in understanding what both gold and Bitcoin do. Here's the logic for gold first. Gold pays you nothing. It doesn't have a dividend, it doesn't pay interest, it just sits there. So when the real rate is high, when you can earn meaningful returns just by holding government bonds, gold looks unattractive. Why hold something that pays zero when safe bonds are paying a solid real return? But when real rates are low or negative, which means inflation is outrunning the interest you earn on bonds, suddenly gold looks very different, because now you're being penalized for holding cash or bonds. Every year, inflation is quietly eating your wealth. And gold, which has held its purchasing power over centuries, becomes the rational alternative. This is not theory. Look at the data across both assets. In 2022, the Federal Reserve hiked interest rates aggressively. Real rates turned sharply positive. Gold fell from around $2,000 to below $1,640, and Bitcoin collapsed, falling over 60% from $47,000 to below $16,500, as cheap money flooded into scarce assets. In 2020, the Fed cut rates to zero. Inflation started rising. Real rates went deeply negative. Gold hit an all-time high of $2,075, and Bitcoin rocketed, surging from below $10,000 at the start of the year to nearly $29,000 by year-end, as cheap money flooded into scarce assets. In 2025, the Fed started cutting again. Inflation stayed sticky above target. Real rates fell. Gold rose 60% in a single year, its best performance since 1979. And Bitcoin also rose sharply, driven by ETF inflows, institutional adoption, and that same macro tailwind of declining real rates. The relationship is not perfect, but the real rate is the most consistent macro driver of both assets, and bonds are what set that real rate. So when you see bond yields moving, the first question should always be, what is happening to real rates? Now let's bring this into the world we're actually living in right now, because the bond market in 2026 is doing something genuinely unusual, and your portfolio needs to understand it. The Federal Reserve cut interest rates 3 times in late 2025. The Fed funds rate now sits at 3.5 to 3.75%. The general expectation had been that the Fed would continue cutting in 2026. But then something changed. Oil happened. Military action in the Middle East effectively closed the Strait of Hormuz, the narrow waterway through which approximately 20% of the world's oil flows. Crude oil went from $61 a barrel in January 2026 to $119 a barrel in March 2026, in weeks. That kind of oil spike is inflationary. It raises the cost of everything, not just petrol at the pump, but shipping, manufacturing, and food. The OECD updated its forecast and projected U.S. consumer price inflation could reach 4.2% in 2026. So now the Fed is stuck. They want to cut rates because the labor market is softening and the economy is slowing. But if they cut rates while inflation is surging, they risk making it far worse, repeating the mistakes of the 1970s when the Fed moved too slowly and inflation became entrenched for a decade. The probability of a rate cut before July 2026 dropped from above 70% to below 40% almost overnight. And here's what that does to bonds. When the market believes rate cuts are being delayed, long-term bond yields rise because the market is pricing in the risk that inflation stays elevated for longer. That widening gap between short-term and long-term yields is called yield curve steepening. And that steepening yield curve is the bond market sending a clear message. We are not confident that inflation is under control. That uncertainty is exactly the kind of environment that historically sent investors toward hard assets, things outside the financial system, things that cannot be inflated away. But, and this is what makes 2026 so fascinating, that didn't happen cleanly. Gold fell, Bitcoin stayed flat, and we're going to explain exactly why in Part 2. Before we zoom out to the bigger picture, there's a story from this conflict that deserves its own moment because it illustrates exactly how complex the gold market can be even when the macro backdrop seems clearly to favor it. Dubai. Most people don't realize this, but Dubai is one of the most important physical gold hubs on the planet.
The UAE exported $58.7 billion worth of gold in 2024, making it the second largest gold exporter in the world. Some estimates suggest 20 to 30% of global physical gold trading flows through Dubai. Now, think about what a Middle East conflict does to that. When the war escalated, gold didn't just face macro headwinds, it faced logistical ones. Shipments flying out of Dubai were disrupted. Traders couldn't move physical gold. And the result was extraordinary. Bullion in Dubai was being sold at a discount of up to $30 per ounce below the global price. Not because gold was worthless, because nobody could get it out.
At the same time, because gold had already surged 60% through 2025 and was trading at record highs, many investors did something counterintuitive. They sold gold, not because they had lost faith in it, but to raise cash, to cover losses in other parts of their portfolio. This is called a liquidity flush. The asset that has risen the most gets sold first, not because it's weak, but because it's where the profit is. Add to that a stronger US dollar, which tends to rise during acute geopolitical fear as international investors rush to the perceived safety of dollar assets, and you have the perfect storm for a short-term gold sell-off inside a war. Gold fell over 20% in the weeks following the start of the conflict. But here's what matters. Analysts at JP Morgan and Deutsche Bank remained bullish through all of it. Their target for late 2026? Potentially $6,000 per ounce if the conflict becomes prolonged, if energy disruptions persist, or if central banks continue accumulating gold to reduce their dependence on the dollar. The short-term price action was brutal. The long-term thesis? Intact. And this is a lesson that applies equally to Bitcoin. Short-term moves, even dramatic ones, don't always tell you what the long-term trend is doing. We'll come back to this in part 2. We want to zoom out now and give the bigger picture, because the bond market is not happening in isolation. There is a structural shift underway in global finance that is making the bond story far more consequential than it would be in a normal cycle. The US dollar has been losing value. The dollar index fell roughly 11% in the first half of 2025, its worst six-month performance since 1973. Morgan Stanley projects another 10% decline by end of 2026. Why does this matter for bonds? Because for decades, there has been a deal at the heart of the global financial system. Oil, the commodity that powers the entire world, was priced and traded in US dollars. That meant every country on Earth needed to hold dollars to buy energy, and holding dollars meant holding US Treasury bonds. It was a self-reinforcing cycle that kept demand for US debt extraordinarily high. That deal is fraying. Saudi Arabia quietly ended its 50-year petrodollar agreement with the United States in 2024. China has cut its U.S. Treasury holdings from $1.3 trillion in 2013 to $682 billion by late 2025. BRICS nations are actively building trade systems that bypass the dollar entirely, and central banks globally have been buying more than 1,000 metric tons of gold per year for 3 consecutive years. That last number is important. Central banks are not buying gold because they think it's a fun trade. They are buying it because they are quietly reducing their dependence on U.S. Treasuries as a reserve asset. They are voting with their balance sheets. The dollar's share of global reserves has fallen from 71% to 56.9% since 2008. That is a slow-motion shift, but it is accelerating. And when foreign governments reduce their holdings of U.S. Treasuries, that reduces demand for U.S. bonds. Lower demand means lower prices. Lower prices mean higher yields, which means the U.S. government has to pay more to borrow, which deepens the debt problem, which reduces trust in the dollar, which sends more investors toward hard assets. Gold and Bitcoin sit at the end of that chain as the two most credible alternatives. But they are not interchangeable. They are very different animals that perform very differently depending on which part of the bond cycle we're in. That is what Part 2 is about. So let's land the plane on Part 1. Bonds are not just for retirees and pension funds. The bond market is the engine of the global financial system, and when it moves, everything, including gold and Bitcoin, moves in response. The real interest rate is the most important number driving both assets over time. When real rates fall, both tend to rise. When real rates rise, both tend to fall. But they don't move in the same way, at the same speed, or for exactly the same reasons, and the March 2026 episode proved that in real time. The Dubai story showed us something crucial. Even when the macro environment should favor gold, short-term dislocations, logistics disruptions, liquidity flushes, a stronger dollar can cause sharp temporary sell-offs. But the long-term institutional conviction remains firm, with JP Morgan and Deutsche Bank targeting $6,000 per ounce for late 2026. And underneath all of this, there is a slow-motion structural shift in global trust. Central banks are buying record amounts of gold. Countries are reducing their U.S. Treasury holdings. The petrodollar system that anchored dollar demand for 50 years is under real pressure for the first time since the 1970s. This is not a story about short-term trading. It is a story about where capital flows over the next decade and what that means for long-term investors holding gold, Bitcoin, or both. In Part 2, watch it right after this one, we pull apart why gold and Bitcoin behaved so differently in March 2026. Same war, same oil shock, same bond market. Gold down, Bitcoin flat. In Part 2, we explain exactly what that tells us structurally and why it matters before you decide how much of each to hold. In Part 3, the final video, we talk positioning. When bonds are rising, falling, or being controlled by the Fed, how should you think about your gold and Bitcoin allocation? What does the evidence actually say? Subscribe to Bitcoin Capital Gold and hit the notification bell. Part 2 is coming shortly and you don't want to miss it mid-series. And if this video gave you something to think about, share it. Most gold and Bitcoin investors are not watching the bond market. In the environment we're entering, that's a gap worth closing. See you in Part 2.